Preparing for a commercial banking at Commercial Bank of Dubai CBD interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work for Commercial Bank of Dubai? I would position CBD as a strong UAE banking platform with deep links to Dubai's corporate, SME, and retail economy. What attracts me is the combination of established banking discipline and digital innovation, especially as customers expect faster, simpler financial services. My background fits because I enjoy client-facing problem-solving, credit analysis, and structured execution. I want a role where I can support growth while respecting risk, compliance, and customer trust. While answering, focus on CBD's UAE banking franchise, digital transformation, corporate and retail presence, customer-centric culture, and how your skills fit relationship management, credit, risk, operations, or service excellence. Question 2. What do you understand about the role of a commercial bank? A commercial bank connects savers and borrowers while providing secure financial services. It collects deposits, lends to individuals and businesses, processes payments, supports trade, and offers treasury or cash management solutions. The bank earns income mainly through net interest margin and fee-based services. In a market like Dubai, commercial banks are especially important because they finance working capital, real estate activity, trade flows, entrepreneurship, and day-to-day financial confidence. Make sure to cover deposit taking, lending, payments, trade finance, treasury services, credit intermediation, risk management, and how banks support households, SMEs, corporates, and the wider UAE economy. Question 3. How would you assess whether an SME borrower should be approved for a loan? I would start with repayment capacity, not collateral. For an SME, I would review historical financials, bank statements, VAT filings if available, customer concentration, supplier terms, and existing debt. Then I would assess cash conversion, how quickly sales become cash, and whether operating cash flow can cover installments. Collateral can reduce loss severity, but it should not justify a weak borrower. I would also check management credibility and sector outlook. In your answer, talk about business model, cash flow, repayment capacity, bank statements, leverage, collateral, management quality, industry risk, existing obligations, credit bureau checks, and early warning signals. Question 4. Explain net interest margin and why it matters to a bank like CBD. Net interest margin is the spread a bank earns between interest-generating assets and interest-bearing liabilities. If CBD lands at an average yield of 6% and funds those assets at 3%, the spread drives core banking profitability. It matters because small changes in deposit cost, loan pricing, or benchmark rates can materially affect earnings. A strong CASA base helps because current and savings accounts are usually cheaper funding than term deposits. Be sure to mention interest income, funding cost, loan yield, deposit mix, CASA balances, rate environment, asset liability management, profitability, and how competition can pressure spreads. Question 5. What is KYC, and how would you handle a customer who is reluctant to provide documents? KYC is the process of verifying a customer's identity, ownership, source of funds, and expected account activity. If a customer resists, I would stay professional and explain that documentation protects both the customer and the bank and is required by regulation. I would clarify exactly what is missing, offer practical submission options, and escalate if the case involves higher risk. I would never bypass KYC to close an account or sale. While answering, focus on regulatory necessity, UAE AML expectations, customer education, respectful communication, escalation procedures, risk-based due diligence, documentation standards, and the need to avoid onboarding shortcuts. Question 6. How does International Financial Reporting Standards 9, expected credit loss, affect bank lending and provisioning? International Financial Reporting Standards 9 requires banks to recognize expected credit losses before an actual default occurs. A healthy loan usually sits in Stage 1 with 12-month ECL, but if credit risk increases significantly, it moves to stage 2 with lifetime ECL. Defaulted or impaired loans move to stage 3. This affects profitability because provisions reduce earnings. It also pushes banks to monitor borrowers continuously, not only when payments are already overdue. Make sure to cover forward-looking provisioning, stage 1, stage 2, stage 3 classification, probability of default, loss given default, exposure at default, macroeconomic overlays, and profit impact. Question 7. If a corporate client asks for a working capital facility, what information would you request?
I would first understand why the facility is needed: receivables financing, inventory buildup, seasonal demand, or supplier payments. Then I would request audited financials, recent management accounts, bank statements, aging schedules, major customer and supplier details, existing borrowing, and collateral information. The key is matching the facility to the cash cycle. For example, invoice financing makes sense only if receivables are genuine, diversified, and collectible within a predictable period. In your answer, talk about purpose of borrowing, operating cycle, receivables, inventory, payables, audited financials, management accounts, bank statements, customer contracts, collateral, facility structure, and repayment source. Question 8. How would you manage a difficult or dissatisfied banking customer? I would first let the customer explain the issue without interruption, then summarize it back to confirm I understood. After that, I would separate what can be fixed immediately from what needs investigation or approval. I would give a clear timeline, document the complaint, and follow up proactively. The aim is not just to calm the customer, it is to solve the root cause while staying within policy and regulatory limits. Be sure to mention active listening, empathy, fact-finding, ownership, compliance boundaries, service recovery, clear timelines, escalation, documentation, and protecting the bank's reputation while solving the issue. Question 9. What are non-performing loans, and how should a bank respond when they increase? Non-performing loans are loans where the borrower is no longer meeting repayment obligations, often measured at 90 days past due or when repayment is otherwise doubtful. If NPLs rise, the bank should not react only through collections. It should identify affected sectors, tighten underwriting, increase monitoring, reassess collateral, and provision appropriately. Some borrowers may be viable with restructuring, while others require recovery action. The response must balance customer rehabilitation and capital protection. While answering, focus on overdue classification, borrower stress, provisioning, restructuring, collections, collateral realization, portfolio monitoring, underwriting quality, sector concentration, and early warning indicators. Question 10. How do CASA deposits help a commercial bank? CASA deposits are valuable because they usually provide cheaper and more stable funding than term deposits. For a bank, a higher CASA ratio can lower overall funding cost and improve net interest margin. It also deepens customer relationships because current accounts capture salary flows, supplier payments, and daily transactions. Once the bank becomes the primary account provider, it can responsibly cross-sell cards, loans, cash management, insurance, and investment products. Make sure to cover current accounts, savings accounts, low-cost funding, liquidity stability, relationship depth, cross-selling, interest margin benefit, transaction banking, and why banks compete for salary and operating accounts. Question 11. What is the difference between secured and unsecured lending? Secured lending is backed by collateral, such as property, cash deposits, vehicles, or receivables. Unsecured lending relies mainly on the borrower's income, cash flow, and creditworthiness. Secured loans normally carry lower risk in pricing because the bank has a secondary recovery source. But collateral is not the primary repayment source, cash flow is. A well-structured secured loan can still become problematic if the borrower's operating fundamentals are weak. In your answer, talk about collateral, repayment source, pricing, risk, recovering prospects, loan-to-value, documentation, examples such as mortgages and personal loans, and why collateral does not replace credit assessment. Question 12. How would you identify potential fraud or suspicious activity in an account? I would compare activity against the customer's known profile. Red flags include sudden high-value transfers, circular transactions,
unexplained third-party payments, frequent cash deposits inconsistent with the business, or activity involving high-risk jurisdictions. In trade cases, mismatched invoices or over-invoicing can be warning signs. I would not accuse the customer directly. I would document the observations, follow internal AML escalation procedures, and maintain confidentiality throughout the review. Be sure to mention unusual transaction patterns, inconsistent customer profile, rapid fund movement, third-party transfers, cash intensity, sanction screening, trade-based red flags, escalation, and confidentiality obligations. Question 13. What impact does rising interest rates have on a bank's customers and profitability? Rising rates can improve bank income if loans reprice faster than deposits, expanding net interest margin, but the benefit is not automatic. Higher rates increase borrowing costs for customers, which can pressure affordability, working capital, and repayment behavior. Depositors may also demand higher returns, raising funding cost. A good bank monitors both sides, profitability and credit quality. Relationship managers should discuss repricing early so customers are not surprised by payment increases. While answering, focus on loan repricing, deposit cost, net interest margin, borrower affordability, credit risk, treasury impact, customer behavior, mortgage burden, and relationship-based pricing decisions. Question 14. How would you contribute to CBD's digital banking and customer experience goals? Digital banking succeeds when it removes friction without weakening controls. I would contribute by understanding customer pain points, encouraging adoption of mobile and online services, and feeding recurring issues back to product or operations teams. In my role, I would also focus on clean data capture and complete documentation, because digital journeys fail when inputs are poor. The objective is faster service, fewer manual errors, stronger controls, and a better customer experience. Make sure to cover customer adoption, process simplification, digital onboarding, straight-through processing, data quality, feedback loops, fraud controls, internal collaboration, and balancing convenience with compliance. Question 15. Tell me about a time you had to meet a target without compromising controls. I would answer with a situation where pressure was real, but controls stayed non-negotiable. For example, if I had a sales deadline, I would prioritize qualified customers, complete KYC properly, and avoid pushing unsuitable products. I would track progress daily, escalate bottlenecks early, and communicate transparently with my manager. The message is that targets matter, but in banking, sustainable performance comes from compliant growth, not shortcuts that create future losses or reputational risk. In your answer, use a STAR structure. Show commercial drive, ethics, prioritization, stakeholder management, documentation discipline, escalation when needed, and the ability to protect customer outcomes and bank policy. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.